Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Imagine a single company just, suddenly stops working tomorrow.
Yeah, it would be catastrophic.
Right. Within a matter of weeks, the entire global artificial intelligence revolution just grinds to a complete, absolute halt. Your smartphone upgrades pause, data centers go dark, and the modern economy effectively freezes.
It's totally paralyzed.
Exactly. So today, for you, the listener, we are taking a comprehensive deep dive into the company holding that exact power, which is TSMC, or the Taiwan Semiconductor Manufacturing Company. And based on recent market analysis, financial data, and official corporate roadmaps from July 2026, we're looking at this massive, glaring paradox.
Yeah, the contradiction here is genuinely, it's one of the most fascinating dynamics in the global economy right now.
Right.
On paper, we are looking at an undisputed juggernaut. They're pulling in record-breaking profits and physically constructing this $265 billion manufacturing empire right here in the United States.
Right here in the U.S., yeah.
Exactly.
Yeah.
Yet, if you look at Wall Street, institutional investors are suddenly getting really nervous and they're selling off TSMC stock.
Which sounds completely backwards. So to set the stage for you, if you're just getting into how these markets work, you have to understand the fundamental mechanics of this AI gold rush we're currently living through. TSMC is essentially the only factory in the world capable of mass producing the absolute cutting-edge pickaxes for this gold rush.
That's a great way to put it, yeah.
Because companies like NVIDIA or Apple, they design the brilliant architecture of the microchips inside your computers, but they don't actually build them.
No, not at all.
Right. They send those blueprints over to TSMC, and TSMC manufactures the physical silicon, so they are the ultimate bottleneck.
Yeah, without their manufacturing capabilities, all those fancy blueprints from Apple are just, theoretical math.
But to really understand why their stock is behaving so erratically despite this total dominance, we have to look at the physical reality of their current expansion strategy.
Okay.
The financial data it doesn't make any sense until you understand the sheer gravity of what they're attempting to build out in the American Southwest. According to recent data, TSMC isn't just like throwing up a single factory in Arizona.
Right.
They are attempting to localize the entire advanced semiconductor supply chain in the U.S.
And the numbers on this, they are just staggering. They recently added another $100 billion to their previous $165 billion Arizona investment.
Which is wild.
It is.
Yeah.
That brings the total to $265 billion.
Yeah.
Just to put that into perspective for you, the listener, that is roughly equivalent to the entire economic output of a small country just being poured directly into the Arizona desert. Yeah, it's a massive undertaking, and it's happening in very distinct methodical phases. So Fab 1 hit high-yield mass production in the fourth quarter of 2024.
Okay, late 2024, and that was using their N4 process.
Right, exactly. Then Fab 2 finished its building structure in 2025, and they are targeting mass production for the second half of 2027 using the N3 process.
Got it.
And finally, Fab 3 started construction in April 2025, aiming for the end of the decade with their cutting-edge N2 and A16 processes.
Okay, let's unpack this for a second, because we throw around terms like N4, N3, and N2 quite a bit in financial news. For you listening at home, these nodes essentially represent the physical size of the transistors on the chip.
The physical switches, yeah.
Right, so N2 means 2 nanometer. And a nanometer is incredibly small. Like, a strand of human DNA is about 2.5 nanometers wide.
It's basically biology scale.
Exactly. So TSMC is printing billions of microscopic switches onto a piece of silicon at the scale of human biology. But the detail and the data that really caught my eye is that this Arizona expansion isn't just about printing those chips. It includes something called advanced packaging, specifically a technology called CoWoS.
Yeah, CoWoS, which stands for chip on wafer on substrate.
Okay, break that down for us.
Sure. So in the past, a microchip was just one solid flat piece of silicon.
Yeah.
But as AI requires more and more computing power, that traditional method, it hit a physical wall.
You literally can't make the chip any bigger.
Exactly. So the industry shifted to what they call chiplets. They print different parts of the processor separately and then stitch them together like this microscopic, three-dimensional jigsaw puzzle.
Oh, wow.
Yeah. And that stitching process is advanced packaging. If you don't line up those connections with absolute atomic precision, the different parts of the chip can't communicate instantly, and the whole AI processor is just useless.
That makes total sense. It's like Let's say a world-famous bakery, not just opening a storefront in your town, but building an entire local farm for their specialized wheat, plus a custom box-making facility next door, just so they never have to rely on overseas shipping.
That's a perfect analogy. U.S. tech giants, your NVIDIAs, your Apples, they are terrified of shipping bottlenecks.
Right.
They don't want a chip printed in Arizona, put on a boat to Asia to be packaged, and then shipped all the way back.
And we really have to contextualize this under the current administration of President Trump, right? Because the administration is heavily prioritizing domestic manufacturing. The U.S. government and these U.S. clients are basically demanding this localized, fully enclosed supply chain.
They are.
But I have to push back on this strategy a bit, because is this massive, vertically integrated U.S. build-out actually economically efficient for TSMC, or are they just, burning cash to appease U.S. politicians and nervous tech CEOs?
Well, the economic efficiency is highly questionable, which is exactly why investors are getting nervous. Geopolitics makes this expansion a necessity, sure, but the physical constraints on the ground are brutal.
Oh, like what?
Let's just start with the location. Building a semiconductor fab requires astronomical amounts of ultra-pure water to wash the silicon wafers.
Right.
Doing this in the middle of the Arizona desert means they have to build incredibly expensive industrial-scale water recycling facilities right on site just to function.
Not to mention the labor constraints, right? Because you can't just hire a general contractor to, pipe highly toxic specialized gases into a clean room.
No, definitely not.
It requires highly specialized construction labor that is in massive shortage here in the U.S., so you'd think burning through $265 billion in the desert while fighting labor shortages and water scarcity would just absolutely crush a company's balance sheet.
You would think so.
But their recent earnings tell a completely different, almost impossible story.
They do. Based on the Q2 2026 earnings data, the financial performance was, it was nothing short of phenomenal. The revenue hit $40.2 billion for the quarter.
Insane numbers.
Yeah, but the metric that truly stands out is their profitability. Their gross profit margin was an incredible 67.7%, and their operating profit margin was 60.3%.
Okay, for any listener who isn't deep into manufacturing finance or economics, let's pause here. A gross margin of nearly 68% in physical hardware is practically unheard of.
It really is.
So if you run a basic business like a lemonade stand, the gross margin is what's left after you pay for the lemons and the sugar. For TSMC, that means for every dollar of physical chips they sell, it only costs them about 32 cents in raw materials and direct labor to actually make them.
Exactly.
The rest is gross profit. Most traditional manufacturers would throw a parade for a 20% margin. How on earth are they commanding that kind of premium?
Monopoly pricing power. Plain and simple. If you are Apple or NVIDIA and you need a 3-nanometer chip printed flawlessly by the tens of millions, there is literally no one else on the planet who can fulfill that order at that scale and yield.
No one.
Right. TSMC knows this, so they dictate the price. And looking at the revenue breakdown, high-performance computing, which includes all the chips for these massive AI data centers, that now accounts for 66% of their total revenue.
Wow.
Yeah. Advanced nodes make up 77% of their revenue. They own the high end of the market entirely.
They even officially raised their 2026 capital expenditure guidance, right, to between $60 billion and $64 billion, meaning they are pouring even more cash into buying the physical equipment for these factories.
Yeah, 70 to 80% of that is going straight to advanced tech.
They are printing money. But here's where it gets really interesting. Despite this practically perfect earnings report, on July 17th, TSMC's stock suddenly dropped 7.3%.
Yeah, it tanked.
The company reports 68% margins, raises their outlook, and investors immediately dump the stock.
What's fascinating here is the underlying psychology of the market. The stock market is a forward-looking mechanism. The reality of TSMC's brilliant quarter was already priced in.
Right.
Investors expected perfection, and they got it. But the sell-off had very little to do with TSMC's execution itself. The market isn't doubting TSMC's ability to manufacture chips. The market is suddenly doubting TSMC's clients.
Okay, explain that.
Institutional investors are suffering from a phenomenon being called AI CapEx anxiety.
AI CapEx anxiety. So Wall Street is looking at the hyperscalers, the Googles, the Metas, the Microsofts, who are just buying hundreds of billions of dollars worth of these AI chips.
Throwing money at it, yeah.
Right. And the anxiety is whether these tech giants can actually sell enough AI subscriptions and targeted ads to eventually pay off these multi-billion-dollar server farms.
Exactly.
It's like taking out a massive loan to buy $1 million commercial kitchen, but you haven't actually figured out how to sell a single sandwich yet.
That is the exact fear driving the market. If Meta suddenly decides that their AI models aren't generating enough actual cash flow, they will slash their hardware budgets overnight.
Wow.
TSMC is riding the wave of their clients' massive spending spree, and investors are terrified that the wave is crested.
Okay, so since big tech's massive spending is making Wall Street sweat, it naturally begs the question of how TSMC is paying for its own massive $265 billion U.S. expansion. Are they leveraging themselves to the hilt with debt to build these Arizona factories?
No, and this is a really crucial point of financial strengths for them. According to the financial analysis, TSMC relies heavily on its own massive operating cash flow.
Okay.
In the second quarter of 2026 alone, the actual cash their business generated day-to-day was around 783 billion Taiwan dollars.
That is a massive influx of cash.
It is. It easily covers their capital expenditures. They aren't fully reliant on going to banks for huge loans, though the chief financial officer did note they could issue corporate bonds if market conditions are favorable, just to keep their options open.
Sure, but there's a consequence to this global expansion. The data shows that the rapid ramp-up of their new 2-nanometer chips, combined with the staggering costs of operating these new fabs in the US, Japan, and Europe, is expected to dilute their gross margins by 2% to 4% in the second half of 2026 and beyond.
Yeah, that dilution is real.
So, what does this all mean for the listener who might hold TSMC in a basic index fund in their retirement account? It's like taking a highly profitable, perfectly tuned local restaurant and forcing them to open a branch in the most expensive neighborhood in another country.
Right.
Yes, your overall revenue goes up because you are serving more people, but your profit per meal drops because the rent, the labor, and the ingredients are all drastically more expensive there.
That restaurant dynamic perfectly illustrates what analysts call the overseas production cost discount. It simply costs significantly more to manufacture in Arizona than it does in Taiwan. The labor is more expensive, the supply chain is less dense, and the infrastructure costs are higher. However, investors are constantly trying to balance that against the Taiwan risk mitigation premium.
Meaning the safety of having chips made on American soil, far away from any geopolitical tension in Asia.
Exactly.
Clients are willing to pay a premium for the guarantee that their supply chain won't be disrupted by global conflicts. But will a company like Apple actually accept lower margins on an iPhone just because the chip was made in Arizona? At some point, the consumer is going to refuse to pay more, and that margin squeeze gets pushed right back onto TSMC.
It is a constant game of chicken overpricing. But clients ultimately pay the premium because they have no alternative. And that brings us to TSMC's competitive dominance.
Right.
Recent data shows TSMC's market capitalization at roughly $1.97 trillion.
Almost $2 trillion.
Yeah, that is almost double the value of Samsung, which is one of their closest competitors and a company with incredibly deep pockets.
Right. So if Samsung has endless billions to spend, why is TSMC so deeply entrenched? I mean, if building in America is squeezing TSMC's margins and they are charging a premium, why doesn't another company just step in, undercut their prices, and steal the market?
Well, the secret sauce isn't just capital. It is high manufacturing yield the ability to print these microscopic circuits with incredibly low failure rates.
Yeah.
But strategically, their deepest moat is their pure foundry business model.
Pure foundry.
Right. They never, ever design their own chips.
So they are like the contract brewer of the tech world.
Exactly.
They will brew the beer for all the famous craft brands, but they refuse to ever release their own label.
Right.
And that creates absolute trust, right? Because if TSMC designed their own chips, a company like NVIDIA would be terrified to hand over their proprietary blueprints, fearing TSMC might reverse engineer the design and become a direct competitor. Because companies like Intel or Samsung actually design and sell their own chips, they inherently compete with their own potential clients. But TSMC remains completely neutral.
That neutrality is their greatest shield. However, it's vital for investors to realize that TSMC does not own the entire AI profit pool.
Okay.
They rely on a vast ecosystem.
Oh.
For instance, a European company called ASML holds a complete monopoly on the extreme ultraviolet, or EUV, lithography machines required to physically print these chips.
I'm glad you brought up UV because it sounds like science fiction.
It really does.
Just to quickly explain this to the listener, to print transistors the size of DNA, you can't use regular light. These ASML machines shoot microscopic drops of liquid tin with a high-powered laser 50,000 times a second, vaporizing the tin into a plasma.
It's mind-blowing.
Right. That plasma emits a specific wavelength of extreme ultraviolet light, which is so small it can manipulate individual atoms on the silicon wafer. TSMC doesn't build these machines, they just mastered the art of using them better than anyone else.
They are the ultimate operators of the equipment. But being the neutral operator in the middle of a global supply chain creates a massive geopolitical blind spot, particularly regarding China.
Hmm.
On one side, there is an insatiable demand for AI chips in the Chinese market. But on the other side, TSMC faces severe regulatory risks. Reports show they could face over $1 billion in fines from U.S. export control investigations related to their chips ending up in Huawei AI processors.
Okay, this is the part that always confuses me. TSMC has strict compliance teams. How does a chip that they legally manufacture and sell to an approved client end up in a restricted server rack in Shenzhen? How can a company protect itself from that?
If we connect this to the bigger picture, it exposes the incredibly porous nature of global hardware logistics. Once TSMC manufactures the chip and hands it over to the client, TSMC loses all physical visibility.
They can't track it anymore.
Exactly. Let's look at a hypothetical gray market scenario.
Hmm.
An approved logistics firm in a neutral country buys a batch of servers. They take delivery, physically rip the processors out of the motherboards, pack them into a suitcase, fly them through a third-party country, and smuggle them across the border into China to be reassembled into a restricted data center.
So TSMC is completely blind to this secondary market. Yet the U.S. government holds them responsible because they were the point of origin.
The enforcement is incredibly strict. That is why investors cannot simply look at the massive demand from China and see guaranteed revenue. They must equally weigh the exit risk, the catastrophic risk of sudden U.S. sanctions.
Right.
If the U.S. government decides to make an example of them, TSMC could lose a massive chunk of global revenue overnight, or face crippling penalties for smuggling that happens 3 layers down in the supply chain.
So, facing these massive geopolitical risks, the threat of billion-dollar fines, and the heavy margin pressures of their $265 billion American expansion, TSMC's ultimate defense seems to be technological velocity.
Move fast.
They have to run so fast and stay so technologically advanced that the global economy literally cannot function without them. So let's look at their future roadmap.
Based on their official corporate roadmaps, TSMC is already looking way past the current AI hype cycle. While the industry is currently fighting over the 2-nanometer process, TSMC has already announced the A14 node.
Right, so the naming convention changes to A, but it represents an even denser, faster architecture than the 2-nanometer chips. And this is the technology that will dictate the future for you, the listener. The A14 node isn't just about faster data centers. The power efficiency of a chip this dense is what will eventually allow your everyday smartphone to run incredibly complex, personalized AI models natively on the device without ever needing to connect to the cloud or drain your battery in an hour.
And the timeline for the A14 node is aggressive. They are targeting risk production in 2027.
Which means they will run the factories to test the process, knowing a high percentage of the chips will initially fail as they dial in the physics.
Exactly, dialing in the physics. And once they stabilize that yield, they are targeting mass volume production by 2028.
I think this is a critical point to synthesize for anyone tracking this market or learning about economics. Long-term investing isn't about panicking when a stock drops 7% on a random Tuesday in July because of capex anxiety.
No, not at all.
You have to watch the horizon. You need to watch if clients are actually committing to these 2028 technologies and whether those massive new Arizona factories can actually stabilize their manufacturing yield so they aren't wasting billions in raw materials.
This raises an important question regarding capital allocation. The key metric moving forward isn't simply, is the AI sector growing?
Right.
The real test is whether that growth is efficiently converting into free cash flow and shareholder returns. They have to prove that the massive premium they charge for supply chain safety in America is consistently higher than the heavy penalty they pay for manufacturing in the desert.
Because revenue is vanity, profit is sanity, and free cash flow is king. If they are spending $265 billion in the United States, they need to prove they can turn that mountain of capital into actual returns despite all the staggering overhead.
They are acting as the physical anchor for the entire modern economy, just bearing this massive capital burden so the software companies can thrive.
Which brings us to the core takeaway of this deep dive. TSMC truly is the ultimate litmus test for this technological era. They aren't just writing code. They are physically building the future. They are pouring concrete, negotiating water rights in the desert, and manufacturing the microscopic brains of tomorrow. So I want to leave you, the listener, with a final provocative thought to mull over.
Okay.
We've talked extensively about Wall Street's fear that tech giants might not generate enough software revenue to justify their spending. But consider the physical reality on the ground. What happens to this $265 billion localized manufacturing dream if a major player like Apple, Meta, or Microsoft suddenly decides they overbuilt and they slash their hardware orders by 30% next year? If the AI hardware hype cools down even slightly, who is ultimately left holding the bag on these massive specialized factories sitting out in the Arizona desert? Don't forget to subscribe and hit that like button.